What are the basic measures of risk that professionals rely on? Well, risk management is a fascinating field that hinges upon the ability to assess and quantify risks, developing strategies to mitigate potential threats and optimize opportunities. Firstly, let's discuss exposure. Exposure is the extent to which an organization is susceptible to a particular risk. For instance, a business heavily invested in the stock market has a high exposure to market volatility. Similarly, a coastal property is exposed to the risk of hurricanes and floods. Moving on to volatility. Volatility gauges the degree of variation in the value of an asset, investment, or market. Tech stocks, for example, often show high volatility due to rapid shifts in market sentiment and technological advancements. Also, commodity prices such as oil and gold face significant volatility due to factors like geopolitical events and supply-demand dynamics. Next, we have likelihood, which assesses the probability of a risk event occurring within a defined time frame. An organization with outdated cybersecurity measures, for instance, has an increased likelihood of a cyber attack. Similarly, if quality control processes are lacking, the likelihood of a product recall rises. Then we come to consequences. Consequences measure the potential impact of a risk event on an organization's objectives, assets, or stakeholders. A data breach, for example, can lead to financial losses, reputational damage, and legal liabilities. Natural disasters like earthquakes or hurricanes can result in severe consequences, including property damage and business interruption. Time horizon is another crucial measure. It refers to the duration over which risks are assessed and managed, considering both short-term and long-term perspectives. Short-term risks might include fluctuations in currency exchange rates or temporary supply chain disruptions. On the other hand, long-term risks encompass trends like climate change, technological innovation, and demographic shifts that unfold over several years or even decades. Finally, we have correlation. Correlation measures the degree to which the movements of two variables, such as risks or assets, are related. A positive correlation between two stocks implies that they tend to move in the same direction, increasing the portfolio's risk. Conversely, a negative correlation between stocks and bonds indicates that they often move in opposite directions, offering diversification benefits. To wrap up, these basic risk measures are essential tools for risk professionals. They help assess, quantify, and manage risks effectively as part of a comprehensive risk management strategy. By understanding exposure, volatility, likelihood, consequences, time horizon, and correlation, risk professionals can identify key risk attributes, develop mitigation strategies, and make informed decisions to protect organizational objectives and enhance resilience in the face of uncertainty. In the coming sections, we will delve deeper into each risk measure, providing practical examples and insights for application in real-world scenarios.